Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today we are taking a deep dive into two incredibly different financial arenas. We're talking digital assets and heavy crude oil.
Hmm.
But they actually share one crucial insight.
You do.
It's that the raw potential of an asset, whether it's massive oil reserves or some cutting-edge tech, is often secondary to the external rules that govern it. So our mission today is to understand how policy decisions, these index rules, and geopolitical control can effectively just override what the market wants.
Mm-hmm.
First, we'll analyze a recent decision by the global index provider MSCI. This is about those companies holding large digital asset treasuries, the DATCOs, and what that one policy means for systemic risk in the crypto market.
All right.
Then we're going to pivot to physical assets and the sticky reality of Venezuelan oil.
Right.
It has the world's largest reserves, yet investment is completely stalled. We're going to explore why political risk and, frankly, the trauma of past nationalizations are far more important than the actual barrels underground.
And that framing is, I think, essential. We are looking at value distortion in real time.
Right.
For you as an investor, it's not enough to know what an asset is worth. You have to know who controls the access points.
The gatekeepers.
Exactly. For crypto, the access points are increasingly policed by traditional finance or TradFi institutions like MSCI. And for Venezuela, well, the access points are controlled entirely by political will and a really painful history of contract violations. We'll show you why that external control just creates this massive drag on potential returns.
Okay, let's unpack this. We're starting with digital assets. Our own research shows a recent positive development for companies like Strategy. You might know it as MSTR because they hold just tremendous amounts of digital currency.
Mostly Bitcoin.
Most of Bitcoin, right? These are the DATCOs.
Right.
And MSCI, this massive index provider, recently backed away from plans to automatically exclude these companies from their flagship stock indexes.
And this index decision, which, it sounds technical and maybe a bit boring, is actually highly significant. If you're a beginner investor, you really need to understand that these DATCOs, which came to prominence around 2025, offer a kind of stock proxy for digital assets.
The proxy.
Yeah. So if you don't want the hassle or the security risk or the regulatory uncertainty of owning Bitcoin directly, you just buy the stock of a company that holds a lot of it on its balance sheet.
So help me picture this for our listener. If I'm buying stock in Strategy, am I buying a software company or am I basically buying an indirect Bitcoin fund?
That is the entire debate. You are technically buying a software company. They still have operating revenues, but the vast majority of their asset value and, critically, the driver of their stock price is the crypto they hold. This is why we often call it a leveraged proxy. When Bitcoin moves, the DATCO stock often moves bigger and faster. To use maybe a simplified analogy, imagine you buy stock in a massive shipping container company. Historically, they made money delivering goods, but suddenly 90% of their value comes from the rare artifacts they store inside those containers. The stock price now reacts mostly to the artifact market, not the shipping business.
That makes the risk factor much, much clearer. So let's get into that index exclusion risk. Why was MSCI even thinking about booting these stocks out? And why would that matter to someone who just owns the stock or even the underlying crypto?
The concern was centered on this idea that these companies were no longer really operating companies, that they were essentially becoming investment funds, and index rules often exclude passive funds from their operating company indexes. If MSCI had decided this, and remember, trillions of dollars track MSCI indexes globally,
Trillions.
especially the passive funds, those funds would be forced to sell all their DATCO shares immediately.
Wow.
And this is where structural risk comes in. If these massive index funds are forced to liquidate billions in DATCO stock, the stock price doesn't just drop, it absolutely plummets. And since these DATCOs are already leveraged proxies for crypto, that sudden forced plunge could cause margin calls and widespread deleveraging, meaning people who borrowed money to invest suddenly have to sell everything.
So the shock from a technical rule change in TradFi could have rippled out and caused a flash crash? This systemic contagion across the whole digital asset market.
Precisely. It's the financial version of the domino effect. The index provider pulls one domino that causes the stock proxy to fall, which then generates enough pressure to knock over the coin market itself.
So this recent MSCI decision.
It weakens that specific contagion pathway. It delays or cancels that forced selling event. So for short-term crypto stability, it's a huge relief.
But if MSCI backed off, I mean, doesn't that prove the market won this battle? Why should investors still worry about a technical definition?
That's the critical nuance here. The research indicates that MSCI didn't give DATCOs a clean bill of health. They just postponed the debate.
Kick the can down the road.
Exactly. The core argument, is this an operating company selling software, or is it fundamentally an investment vehicle holding crypto?
Right.
That is still completely unresolved. This continued uncertainty means that regulatory and policy risk, it remains a key input into the valuation of these stocks. This prolonged classification controversy means a change in policy, or just a reinterpretation of the rules down the road, could still trigger a similar crisis.
So investors now have to factor in some indexer's judgment call as a major variable.
Right alongside Bitcoin's price volatility, yes.
So the major takeaway for investors is that in 2026, crypto stability is no longer just about network development or spot trading. You have to pay attention to the index rules of TradFi.
Because that is where the largest pool of passive money lives. And that money has the power to amplify shocks across the entire ecosystem. The gatekeepers of passive investing are now effectively the gatekeepers of crypto stability.
All right, let's pivot now from the digital realm to the physical, sticky world of energy, and specifically Venezuela. We know it holds the world's largest proven oil reserves. So given the current high global oil prices, why aren't the majors, Chevron or ExxonMobil, just rushing in now that U.S. sanctions are softening?
The issue, as our materials clearly lay out, is not the oil underground. It's the collapsed infrastructure and the pervasive political risk above ground. We're not talking about simple investment here. We're talking about wholesale reconstruction. The facilities are dilapidated, pipelines are failing, ports are inefficient, and critically, the workforce has been decimated. Rystad Energy estimates that just to maintain the current relatively low production, around 1.1 million barrels a day, you need a capital expenditure of $53 billion.
$53 billion, just to maintain.
Over the next 15 years. To scale up significantly requires sustained, massive annual investment over decades.
That sounds just astronomical, but why is it so expensive? Can't they just drill more holes?
It's not just about drilling. Venezuela's reserves are overwhelmingly heavy and extra heavy crude. This oil is thick, like cold molasses. You can't just pump it.
Right. You need specialized equipment, these things called upgraders, to process it. And you need diluents like naphtha or lighter crudes to mix in with it, just to make it thin enough to actually flow through these long pipelines to the port.
So it's a huge operational lift.
A huge lift. A good way to think about it is, imagine trying to push thick coal honey through a tiny straw that's 500 miles long. You need to add water, that's the diluent, to make it manageable. Venezuela just doesn't have the capability to produce or source enough of that diluent, and it lacks the infrastructure to handle the viscous crude efficiently.
So it's only really profitable during peak oil booms.
Exactly. Low global prices just amplified all those operational risks.
That explains the operational side. But let's look at the political hurdles, which seem far more challenging. President Trump has recently discussed mechanisms for bringing Venezuelan crude to U.S. ports under U.S. control and then handling the sales.
Right.
If the U.S. is guaranteeing the logistics, why is private capital still so hesitant? Shouldn't that stability from U.S. involvement actually reduce the risk? Well, this is where we get back to the trauma. The idea of political control over logistics and cash flow, even if that control comes from the U.S. government, is the precise definition of discretionary policy risk that drives capital away.
No.
Big oil has been burned before, badly. Starting in the early 2000s, Venezuela nationalized assets, just seized them from foreign companies.
Took them.
Companies like ConocoPhillips and ExxonMobil fought these long, drawn-out legal battles. ConocoPhillips alone has had over $12 billion in claims filed through arbitration courts.
$12 billion.
Yeah.
That's a staggering figure.
Yeah.
What does that historical loss tell us about their current concerns?
It tells them that the state of Venezuela, regardless of the administration in power, has a history of prioritizing politics over contracts. And oil majors prioritize two things above all else: contract enforceability and, most importantly, control over the cash flow. They have to know that if they spend billions on reconstruction, the money they earn from selling that oil goes directly into their bank account, not through some government intermediary that might divert or delay the payment because of political whims.
So the key question for an Exxon isn't, is the oil there? It's, if I ship 1 million barrels, am I guaranteed to take that profit home without interference, even if the government changes next year?
Precisely. And when the U.S. government discusses controlling the sales flow, it introduces a whole new layer of policy risk. Who enforces the contracts against the U.S. government if their policy changes? The certainty that private investors need, clarity on control, on sales, on payment safeguards, on non-seizure guarantees, it's absent.
Right.
And this all leads to the fundamental investment calculation. Companies look at the risk-adjusted discount rate. For a beginner, think of it like this. To justify a huge long-term expense, you need a certain rate of return. In Venezuela, that required rate of return needs to be massive because the country risk premium, the risk of the government just seizing your assets or changing the rules, is extremely high. You're basically adding a huge policy penalty to your investment cost.
Meaning that no matter how high the price of oil goes temporarily, that policy penalty is so large that it makes any long-term multi-billion-dollar investment look like a highly leveraged gamble.
Exactly. In the energy sector, resource volume is irrelevant if the institutional framework collapses. Contract enforcement dictates value, not the physical presence of crude.
That was a really powerful deep dive. Let's quickly recap the insights we've uncovered today. First, we learned that a key systemic risk, one connecting crypto to passive stock funds, was reduced by MSCI. And this really confirms that traditional finance index rules are now vital inputs to cryptocurrency stability. The fight over classifying DATCOs as operating companies versus investment funds, though that remains a persistent and pretty dangerous variable.
It does.
Second, we saw that political control over oil logistics and that historical trauma of nationalization means Venezuela's massive reserves remain effectively locked up by policy risk. Investment, there isn't a bet on the price of oil.
It's a leveraged gamble on institutional and political certainty.
Right.
And here's a final provocative thought for you to explore. If index classifications, a simple definitional argument over whether a company is an operating company or an investment fund can trigger systemic risk across a multi-trillion-dollar market like crypto. What other established financial products that currently rely on specific index rules? I'm thinking, infrastructure funds or maybe certain specialized commodity ETFs. What other products might be vulnerable to an arbitrary or sudden reclassification? The world of financial stability is often built on surprisingly thin bureaucratic definitions.
Fascinating. And definitely something to think about as you review your own portfolio. Thank you for diving deep with us today. Don't forget to subscribe and hit that like button.